Picture a marketplace thousands of years ago, long before the jangle of coins or the rustle of paper bills was ever heard. Here, the rhythm of commerce followed the ancient dance of barter, a system so old that traces of it reach back as far as 600 before Christ among the tribes of Mesopotamia. Imagine a farmer, burdened with grain, seeking the potter's sturdy jars. The exchange seems simple, but in reality, bartering required a delicate balance of desire and need. Each transaction depended on what scholars call a double coincidence of wants. Both participants had to want what the other offered at exactly the same moment. If the potter wanted grain but the farmer needed shoes, the deal fell through unless a third person joined in. Barter, as historians define it, is the direct, reciprocal exchange of goods or services without the use of money. It stands as one of the earliest economic systems, and evidence shows it often coexisted with other forms of value exchange. In fact, no society has ever relied solely on barter. The reality was always more complex, with credit, gift-giving, and various forms of debt woven into early economies. The limitations of barter became clear as societies grew and diversified. Every trade required lengthy negotiation, and transactions could stall if needs did not align. This inefficiency became a significant burden as communities expanded and trade networks stretched farther. While agriculture and settled societies emerged between 10,000 and 8,000 before the Common Era, barter as a system is evidence from around 600 before Christ. As people began to grow their own food and settle in larger groups, the volume and variety of goods exchanged increased dramatically. In these growing communities, places like the Fertile Crescent, Mesopotamia, the Indus Valley, and China trade became both more necessary and more complicated. The simple act of swapping one item for another was no longer enough. There was a growing need for something that could stand in for any good or service, something everyone agreed held value, a universal language for exchange. The solution, though gradual, was profound. Societies began using objects of agreed-upon value as intermediaries in trade. Livestock, grain, shells, and beads all served this purpose. These were the earliest forms of what scholars call commodity money, items that had intrinsic value or were otherwise desirable within a culture. In some Native American societies, wampum beads, small tubular shells, were used as a medium of exchange. In others, cowrie shells, glass beads, or even whale teeth played similar roles. Across ancient civilizations, materials like salt, metals, or axe heads became valued not only for their utility, but also for their role in facilitating trade. With commodity money, people could store value, measure the worth of their goods, and trade more efficiently. Unlike barter, money did not require the double coincidence of wants. A farmer with grain could sell it for shells or beads and later use those to buy shoes from the cobbler. This reduced transaction costs and smoothed the flow of commerce. Over time, however, the limitations of commodity money became apparent. Some commodities were bulky, perishable, or difficult to divide. Stones or livestock, though valuable, were far from ideal for everyday transactions. As trade networks expanded and societies became more complex, the need for money that was durable, portable, and easy to standardize became increasingly clear. The essential characteristics of effective money began to emerge. Durability was crucial. Money needed to withstand daily use. Portability allowed value to be moved easily from place to place. Uniformity ensured that each unit of money was equivalent to another, avoiding disputes over worth. Divisibility made it possible to trade in both large and small amounts, while recognizability allowed everyone to quickly identify what was and was not money. Finally, stability, the ability of money to hold its value over time, became a prized attribute, distinguishing good money from bad. Given these requirements, it is not surprising that societies turned to metals. Metals are naturally durable, can be shaped and standardized, and have intrinsic value in many cultures. The first known minting of coins appears to have taken place in China around 640 before the Common Era, where cast bronze pieces began to circulate as currency. However, the invention of true coinage is most often credited to the Lydians, in what is now Western Turkey, soon after 650 before Christ. Ancient writers such as Xenophanes and Herodotus mention these early coins, which were stamped with the image of a lion and made from electrum, a naturally occurring alloy of gold and silver. Coins represented a transformative leap in the history of money. For the first time, value could be standardized and guaranteed by an authority, often a king or city-state, whose mark affirmed the coin's weight and purity. This trust in the issuing authority was crucial. The network of users, bound by confidence in the system, gave coins their utility and power. Coins made transactions faster, smoother, and more reliable. They became the backbone of regional and, eventually, international trade. The techniques for making coins, whether hammered or cast, spread rapidly across the ancient world, from Lydia to Greece and Rome, and then further afield. The archaeological record is rich with examples of early coins, offering a vivid glimpse into the economic life of ancient civilizations. The Lydian lion coins, for instance, are among the earliest ever found, and their standardized design set the stage for countless successors. As coinage spread, so did techniques for ensuring uniformity and combating counterfeiting. The recognizability and authority behind each coin made them an effective tool for both large and small transactions. As societies expanded, the evolution of money did not stop with coins. In China during the Yuan dynasty, paper money made its first appearance, marking another leap in the abstraction of value. Yet coins remained central to most economies for centuries, with each region developing its own systems and standards. In the United States, for example, the establishment of the United States Mint in 1792 marked the beginning of a national coinage system. Before that, Americans relied heavily on foreign coins, and the transition to a uniform decimal-based currency was gradual and sometimes contentious. The early United States system even allowed both gold and silver coins to circulate side by side, a bimetallic standard before foreign coins were demonetized in 1857. The move toward standardized currency did not happen overnight. It was an adaptive response to the growing complexity of economies and the need to facilitate ever wider networks of trade. Each step, from barter to commodity money to coins and beyond, addressed the inefficiencies of the previous system while building on its foundations. Historians generally agree that the development of money is inseparable from the broader story of civilization itself, as communities sought ever more effective ways to organize, store, and transfer value. But what exactly makes something money? Economists and historians point to three core functions. Money serves as a medium of exchange, a unit of account, and a store of value. As a medium of exchange, money allows people to trade goods and services indirectly, breaking the limitations of barter. As a unit of account, money provides a common yardstick for measuring value, making it easier to compare prices and keep records. And as a store of value, money preserves wealth for future use, provided it is stable and widely accepted. To fulfill these roles, money must possess certain characteristics, those same traits that ancient societies gradually discovered and refined. Durability ensures that money can survive repeated handling. Portability makes it practical for daily use. Uniformity and recognizability minimize disputes and confusion, while divisibility allows for both large and small transactions. Stability is perhaps the most elusive quality, as it depends on both the material used and the trust placed in the system as a whole. Over time, the materials used as money changed, but the underlying principles remained. Gold and silver became especially important in many ancient economies, not only for their beauty and rarity, but for their consistency and universal appeal. These metals formed the backbone of commodity money systems, where the value of money was directly tied to the substance from which it was made. Commodity money offered a measure of stability, especially when backed by a trusted authority, and it remained dominant for centuries. Eventually, societies began to move away from commodity money towards systems based on trust and authority alone, what is now called fiat money. Unlike coins made of precious metals, fiat money derives its value not from its physical substance, but from the collective agreement of its users and the backing of the issuing government. This shift allowed for greater flexibility and control over the money supply, but also introduced new challenges, especially in maintaining stability and trust. Throughout this long evolution, the story of money is not just about economics. It is about human ingenuity in overcoming obstacles, building networks of trust, and seeking ever more effective ways to organize life together. From the first tentative barters to the stamping of coins and beyond, each step in the history of money reflects a search for solutions to practical problems, the need to measure, store, and exchange value in a world that is always changing. As we reflect on this journey, it becomes clear that the foundations of money are built on both necessity and innovation. Societies have always sought to create systems that are efficient, reliable, and adaptable. The evolution from barter to coinage was more than just a change in the objects used for trade. It was a revolution in how people related to one another, how they organized their economies, and how they imagined value itself. The coins and currencies that fill our pockets today carry with them the legacy of countless generations, each one striving to make the business of life just a little bit easier, a little more secure, and a little more fair. Trust is the silent architecture beneath every modern monetary system. Unlike the clinking weight of ancient coins, today's money exists mostly as numbers and ledgers, zeros and ones flickering across digital screens, promises honored by institutions rather than by metal. The world's economic engine now runs on what is called fiat money, currency declared legal tender by governments, untethered from gold, silver, or any other commodity. Its value resides not in substance but in the collective faith that, tomorrow, a dollar, euro, or yen will still be accepted for goods and services. This profound shift from tangible money to abstract value is the defining feature of contemporary monetary systems. At the center of this system stand the central banks. Institutions such as the Federal Reserve in the United States, the European Central Bank, and the Bank of Japan hold a unique and powerful role. Central banks are the sole creators of base money, what economists call fiat money, and they act as the ultimate providers of liquidity in national and global markets. Their actions ripple outward, influencing not just interest rates and prices, but the daily lives of millions. The structure of modern monetary systems is remarkably consistent across major economies. National currencies, managed by central authorities, circulate through networks of commercial banks and digital payment rails, enabling exchange, saving, and investment on a scale unimaginable in earlier centuries. But how, exactly, is money created in this system? It is tempting to imagine that central banks simply print currency at will, but in reality, the process is subtler and more complex. In the modern economy, most new money comes into being through the banking system. When a commercial bank makes a loan, whether for a new home, a business expansion, or a car purchase, it does not hand over cash drawn from an existing pile. Instead, it credits the borrower's account with a new deposit, creating money out of thin air. This is the essence of money creation by commercial banks. Every loan generates a matching deposit in the banking system. Meanwhile, the central bank exerts control by managing the cost and availability of reserves, the special kind of money that banks use to settle debts with one another and with the central bank itself. This relationship between central banks and commercial banks is sometimes described as a system of debits and credits, with government deficit spending creating credits in the wider economy. When a government spends more than it collects in taxes, it injects new funds into the financial system, funds that ultimately become deposits in commercial banks. From here, the interplay between government spending, central bank operations, and commercial lending determines the total supply of money in the economy. Modern monetary theory, often called MMT, takes this logic even further. MMT's core assertion is that sovereign governments that issue their own currencies are not financially constrained in the same way households or businesses are. Such governments can always create additional money when needed. They do not need to rely on taxes or borrowing to fund their spending. According to this view, the primary constraint on government spending is not insolvency, but inflation. If too much money is created relative to the economy's productive capacity, prices will rise and the value of money will erode. This perspective has sparked vigorous debate among economists and policymakers, with some arguing that it opens the door to necessary investment in public goods, and others warning of the dangers of unchecked inflation. Regardless of where one stands in this debate, MMT has helped clarify the mechanics of modern monetary operations and the unique power of states to shape their economies. Central banks wield a sophisticated toolkit to steer the monetary system and pursue their dual goals: price stability and support for economic output. The most familiar of these tools is the management of short-term interest rates. By raising or lowering the rate at which banks can borrow reserves, central banks influence the cost of credit throughout the economy. Higher rates tend to slow lending and spending, cooling inflationary pressures. Lower rates encourage borrowing and investment, supporting growth during downturns. Beyond interest rates, central banks employ a suite of mechanisms to regulate the money supply. Open market operations. Buying and selling government securities are used to add or withdraw liquidity from the banking system. Reserve requirements specify the fraction of deposits that banks must hold in reserve, limiting their ability to expand credit. In extraordinary circumstances, as seen during the global financial crisis of 2008 and the economic shock of the COVID-19 pandemic, central banks have also engaged in quantitative easing, large-scale purchases of government and sometimes private assets, designed to lower long-term interest rates and flood the financial system with liquidity. These interventions are not without risk. The abandonment of the gold standard has freed central banks to respond flexibly to economic shocks, but it has also placed enormous responsibility on their shoulders. Printing too much money or expanding credit too rapidly can erode confidence and stoke inflation. The dangers of runaway price increases are especially acute in fiat money systems, where value depends so heavily on trust in the currency and its stewards. The delicate task of controlling inflation is a central preoccupation for policymakers. Governments and central banks deploy a range of strategies to keep prices stable. If inflation threatens to rise above target levels, central banks can tighten monetary policy, raising interest rates, selling securities, or increasing reserve requirements. Such contractionary measures make borrowing more expensive, dampen spending, and slow the economy, which in turn helps rein in price growth. Conversely, when faced with the risk of deflation or economic stagnation, central banks can loosen policy, encouraging borrowing and investment. This countercyclical approach is the cornerstone of modern monetary management, aiming to smooth out the boom and bust cycles that have plagued economies in the past. The Federal Reserve, as the central bank of the United States, offers a vivid example of these principles in action. The Fed sets monetary policy to influence interest rates and broader financial conditions, using tools such as interest on reserve balances, overnight reverse repurchase agreements, the discount rate, and open market operations. Its decisions affect not only the economy's trajectory, but also the global financial system, given the dollar's dominant role in international trade and finance. In recent years, the Fed and other central banks have also expanded their toolkits, experimenting with new approaches to promote financial stability and adapt to evolving economic realities. Yet, central banks do not control all aspects of money creation, nor do they operate in isolation. The interaction between bank-created money, central bank policy, and the broader economy is dynamic and complex. When commercial banks lend, they effectively expand the money supply, but their ability to do so depends on factors like interest rates, regulatory frameworks, and the demand for credit. Central banks, for their part, set the price of reserves and influence lending conditions, but the ultimate creation or destruction of money occurs at the intersection of banking practices, government fiscal policy, and the choices of households and businesses. The processes of money creation and destruction are not limited to loans and repayments. Payments of dividends and interest can also add or subtract money from the economy, underscoring the intricate flows that define the modern monetary landscape. All of these elements are woven together in a system that is institutionally complex, but ultimately designed to enable economic activity, manage risk, and foster stability. In recent years, the accelerating pace of technological change has brought fresh challenges and opportunities to the world's monetary systems. The rise of digital payment platforms, financial technology innovations, and new forms of digital assets are reshaping the way people interact with money. Central banks are keenly aware of these shifts and are working to adapt. Digital payments have become ubiquitous in many countries, offering greater speed and convenience, but also raising questions about privacy, security, and access. Perhaps the most profound development on the horizon is the potential issuance of central bank digital currencies, or CBDCs. These are digital forms of state-backed money designed to provide the public with safe, direct access to central bank funds in a world increasingly dominated by private digital payment platforms. The introduction of CBDCs could transform payment systems, affect competition among banks and payment providers, and raise significant legal and regulatory questions. Central banks are studying these implications carefully, considering how wider access to central bank money might influence financial stability and the role of banks in credit creation. The movement towards CBDCs is part of a broader rethinking of what money is and who gets to issue it. The proliferation of private digital currencies and blockchain-based assets has sparked debate about monetary sovereignty, the ability of states to control their own currencies and financial systems. Some central banks worry that widespread adoption of private digital currencies could erode their capacity to manage the economy and maintain stability. As a result, many are exploring how to harness technological innovation while preserving the fundamental roles of public money and monetary policy. Regulation is evolving alongside technology. The rapid integration of digital payment systems, the emergence of stablecoins, digital tokens pegged to traditional currencies, and the push for real-time payment infrastructure are prompting central banks and regulators to update their frameworks. The goal is to safeguard financial stability, ensure fair competition, and protect consumers, even as the boundaries between traditional banking, financial technology, and new payment technologies blur. Looking ahead, the future of monetary systems will likely be shaped by a blend of continuity and disruption. The foundational elements, fiat money, central banks, and the mechanisms of credit creation remain vital, but they are being adapted to meet the demands of a digital, interconnected world. The complexity of managing currency, controlling inflation, and ensuring economic stability is only increasing as technological change accelerates and new actors enter the financial landscape. Central banks are called upon not only to master the traditional tools of monetary policy, but also to anticipate and manage the effects of innovations that could redefine the very nature of money. In sum, the structure and function of modern monetary systems rest on a delicate balance: the trust of the public in the currency, the stewardship of central banks, and the dynamic interplay of government, banks, and technology. Understanding this balance is essential for anyone seeking to grasp the forces that animate the global economy today. As society continues to innovate and adapt, the architecture of money will continue to evolve, but the importance of trust, authority, and prudent management will endure. If you listen closely to the hum of daily life in the 21st century, you will notice that money is undergoing its most profound transformation in centuries. Not since the emergence of paper banknotes or the birth of fiat currency has the meaning of money and the systems that support it changed so rapidly or so unpredictably. This digital revolution is not unfolding in laboratories or boardrooms alone. It is playing out on smartphones, in online marketplaces, and across the vast networks that now connect billions of people. At its core, the future of money is being shaped by code, connectivity, and an increasingly digital world. Consider for a moment the astonishing speed with which digital payments have become the norm for many people around the globe. In some countries, cash is now the exception rather than the rule, as contactless cards, quick response codes, and digital wallets replace coins and notes. The simple act of paying for a coffee, hailing a ride, or splitting a bill has been transformed, often reduced to a tap, a swipe, or the scan of a phone. Beneath these conveniences lies a complex web of financial infrastructure, much of it powered by distributed ledger technology such as blockchain. These systems are not only making transactions faster, they are also introducing new levels of transparency, liquidity, and interoperability that were previously unimaginable in traditional banking. Yet, the most striking development of recent years has been the rise of cryptocurrencies. In 2024, global cryptocurrency ownership reached approximately 6.8%. A figure that translates to over 560 million individuals worldwide. The pace of growth is rapid, with new users joining at rates that surpass the adoption curves of many past financial innovations. Demographic data reveal that cryptocurrency owners are not confined to a single region, age group, or economic class. Instead, adoption is broad, with countries in Asia, Africa, and Latin America often leading in both total numbers and rates of increase. These patterns are tracked closely by various indices, which show that while some nations experience a steady climb, others have seen surges tied to local economic events, regulatory changes, or the popularity of particular digital assets. By 2026, projections suggest that up to 30% of United States adults may hold some form of cryptocurrency, a dramatic increase from previous years. This marks a dramatic shift in public sentiment and participation, especially considering that just a decade earlier, cryptocurrencies were largely the domain of technophiles and early adopters. The most popular choices remain Bitcoin and Ethereum, but stablecoins and other digital tokens have also attracted substantial followings. Policy changes and regulatory debates clearly influence these trends, as does the growing presence of institutional investors and financial technology companies eager to serve this expanding market. What draws so many people to digital assets? The answers are as varied as the users themselves. Some are attracted by the promise of decentralization, a system where no single authority holds all the power. Others see cryptocurrencies as a hedge against inflation or currency devaluation in their home countries. For many, the appeal lies in the seamlessness of cross-border payments, the possibility of financial inclusion, or simply the sense of participating in a new frontier. The rapid adoption rates, tracked year by year in global indices, suggest that digital currencies are not a passing fad, but a movement gaining momentum with each news cycle, each technological breakthrough, and each new generation of users. But the digital revolution in money is not limited to private cryptocurrencies. Central banks, long the stewards of traditional monetary systems, are now exploring their own digital innovations. The emergence of central bank digital currencies, or CBDCs, reflects both an opportunity and a response to the challenges posed by private digital assets. CBDCs are, in essence, digital forms of state-backed money, issued and regulated by central authorities rather than decentralized networks. Proponents argue that CBDCs can address a range of economic and financial challenges, from improving payment efficiency to enhancing monetary policy transmission and increasing financial inclusion. They offer the promise of public access to reliable digital money without the volatility or risk that sometimes accompanies private cryptocurrencies. The path forward for CBDCs, however, is anything but straightforward. As central banks weigh the benefits and risks, they are confronted with a host of crucial questions: how to balance privacy and security. What role should commercial banks and payment providers play in a world where individuals might hold accounts directly with the central bank? How might CBDCs affect cross-border transactions, or the delicate balance between innovation and stability? These debates are ongoing, and while some countries have already launched pilot programs or early versions of CBDCs, others are proceeding with caution, mindful of the potential for unintended consequences. The underlying technologies driving these changes are also reshaping the very architecture of financial markets. Distributed ledger systems, such as blockchain, are revolutionizing not just payments, but the broader infrastructure of finance. These systems enable the creation of digital tokens that can represent not only money, but a wide array of assets from stocks and bonds to real estate and intellectual property. Experts suggest that this tokenization of value could unlock new forms of liquidity, making it easier to buy, sell, and transfer assets across borders and platforms. At the same time, greater transparency and interoperability may help reduce the costs and frictions that have long characterized international finance. Yet, as with any revolution, the opportunities are matched by significant challenges. The transition from cash to digital currencies has far-reaching implications for privacy, security, and access. For some, the end of cash raises concerns about surveillance and the loss of anonymity in transactions. Digital systems can be vulnerable to hacking, outages, and other technical failures. Questions of digital literacy and equitable access remain pressing, especially in regions where internet connectivity is limited or unevenly distributed. Policy responses to these challenges are still evolving. Regulators and governments are grappling with the rapid pace of technological change, seeking to safeguard financial stability while fostering innovation. The proliferation of new players, from financial technology startups to global technology giants, has blurred the boundaries between banking, payments, and digital services. Experts point to the rise of digital wallets, tokenized dollars, and programmable money as indicators that all money could eventually become digital in some form. The regulatory frameworks of tomorrow may look very different from those of the past, as authorities seek to balance the promise of efficiency and inclusion with the necessity of oversight and protection. As we look to the future, the contours of the next monetary era are beginning to take shape. One can imagine a world where digital wallets rather than physical banknotes serve as the default means of storing and spending value. In this world, everyday transactions, whether for groceries, rent, or international remittances, are settled instantly and securely, regardless of borders or banking hours. Money itself becomes programmable, capable of carrying conditions or instructions embedded in code. The lines between different types of money, government-issued, privately created, stable, or volatile, may blur as users move seamlessly between platforms and currencies according to their needs and preferences. Yet, the ultimate shape of this future remains uncertain. The digital revolution promises a transformative future for money, but it also raises new risks and dilemmas. Financial inclusion could be greatly enhanced, giving billions access to modern payments and financial services for the first time. At the same time, the displacement of cash and traditional banking could leave some people behind, especially the unbanked, the elderly, or those in rural areas. The risk of cyber attacks, data breaches, or system failures cannot be dismissed. Policymakers, technologists, and citizens alike will need to navigate these waters carefully, weighing the benefits of innovation against the imperatives of trust, security, and inclusion. What is clear is that the transformation of money is no longer a distant prospect. It is happening now, in real time, fueled by the ambitions of innovators, the decisions of central banks, the calculations of regulators, and the everyday choices of millions of users. The digital revolution is reimagining old boundaries, challenging long-held assumptions, and offering new tools for economic participation and growth. The story of money, a story that began with barter, passed through the ages of coin and paper, and evolved into the complex fiat systems of the modern era, now enters a new chapter, one written in lines of code, shaped by networks, and defined by the interplay of trust, technology, and human ingenuity. As this chapter closes, the questions that loom are as profound as any that have come before. How will societies preserve privacy and security in a world without cash? What role will central banks play when anyone can create a digital token? How will nations collaborate or compete in an increasingly borderless monetary world? These are questions without easy answers, but they are the questions that will define the future of money. For now, we stand at the threshold, watching as the digital revolution transforms not only how we pay, but how we think about value itself. The journey continues, and its destination remains, as ever, shaped by our collective choices and aspirations.